Hello and welcome to another episode of the SwingTrader Status Update. This is our monthly chance to check in with our SwingTrader subscribers, let you know a little bit about what is going on in our heads, and a little review of the portfolio, the model portfolio that has been coming to you for the last month. So to help me out, as he always does, it's Mike Webster, our what is it? Senior market strategist? What are you? Yeah, senior market
Officially,
strategist.
I just got a card in the mail. It says "Random Dude from Austin."
Okay, there we go. And I mean, and other places since you did your recent road trip
Oh yeah, so
and
I
went
have
all
to put a
over.
lot of 6,700 miles
Yeah,
of places that I
we'll have
went.
to put stickers all over your forehead or something for all the places you went. Of course, today is August 12th, 2025, and Mike, let's get right into it. I'm going to pull up the Nasdaq because I'm sure what's on everyone's mind is how strong this market has been, and the Nasdaq composite making new highs today, up 1.4%. Now, look, it hasn't been an easy road lately for this month after trending above that 21-day moving average line for 65 days with the low above the 21-day moving average line. We had our first close below it on August 1st, and what a day that was after the jobs report. CPI came out today, so there is still kind of the economic news, in the background. But what a reaction! What are your thoughts? Let's talk market.
Well, so this is a very interesting time that we're in right now because I mean, with at the market at highs looking like this, stretched above the 21 day, I would normally be extremely bullish.
Mm-hmm.
I'm bullish by what we're doing in the market. We're fully invested in we're like 1% on margin, maybe. So I just can anything within a couple percent, I just considered fully invested, but we're spread out because really, and you touched on it with being above the 21 day for so long. What the two of us did is when we broke the 21 day, we were looking at all the times where we had been extended above the low had been above the 21 day for this long, and looked at that sample. And what I'd asked you for was to do it for all the times where the to get the data for all the times where the low is above the 21 day, even just one day, and then just lay out the data and see like where were we, because it was feeling long, but it was just hard to put a number on it, and we were in the 98th to 99th percentile of our time above the 21 day. So the two of us went back and looked at all of those times where you'd been above it just as long or longer. I think there was one in there that was like 109 or 110 days where the low would have been above the 21 day without touching it or breaking it. And those really got me in a negative mindset because it wasn't that they went lower. They most of them ended up going higher, but you were in a different market environment. Put another way, that when you're trending above the 21 day for a long period of time, the way we were, when you finally do touch it or break, the trend is different, not necessarily down. Most of them, like I said, did go higher. And we touched on those on the SMT video on Friday a couple weeks back. If anyone's interested, you can find that on our site or on YouTube. And we went through some examples there, but really it's that kind of got me more defensive, but yet there were still a lot of things for us to trade. And so you don't trade the market you fear, you trade the market that's in front of you. So that's what we've been doing. So we're still full in and really exposed, but we're doing it in a kind of a different way right now. All of our positions are half size positions,
Mm-hmm.
and that's on
Even the
purpose.
ETFs.
Even the ETFs, and
Mm-hmm.
nothing on swing trader happens by accident. It's all, by design. Doesn't mean it's always going to be right, but we wanted to have half positions for right now because we do have a lot of, risk just based off of our precedent analysis of looking at other times when we just don't know what this new trend is. The other trend was very well defined, and you could we do our regression analysis, and that is working on it. Is very bullish, and looks normal and natural. But it was really just that break of the 21 day that just got me on. And normally I'm either all kind of bullish or all bearish, but right now I'm kind of a little bit of both, which is an unusual most people on the street always like to hedge themselves. Oh, I'm bullish, but I'm bearish. I'm bearish, but I'm bullish. But that's not me. I kind of stick my neck out there. But right now, I'm just I'm on both sides of it. But my account is fully invested on personally, as well as what we've got here with SwingTrader. We might go out on margin. There were other things that we could have done today to put us out on real margin, but we decided not to. I mean, let's go to one of them, IWM. I did end up buying this in my own account, and I was really contemplating us putting this on SwingTrader, but we've been burned on it so many times. Over the last, I've been burned on it so many times over
I
the
was
last
going to say,
four years.
I don't think that we've necessarily been burned on it nearly as many times as you and I have personally.
Hmm.
So SwingTrader, we haven't spread that that love to everybody. With Lucy pulling the football away on this one.
Yeah, that's a good way to put it. 'Cause every time it looks set up and you're thinking, okay, a little bit of a mean reversion or even this working, it is, it would look good for a day, maybe 2 or 3 days, and then something would happen and it would just go back to the old. Let's go to the FNGS, which is your mega cap stocks, and it would just kind of revert back to this one. Now, with this, the mega caps, you can kind of see it's not back at highs, and it kind of this looks more like what I was expecting the entire market to do when we had that where my eyes just go to your top day, followed by that really nasty day, that gap down closing at your lows. And really thought what would be normal and natural, just based on the historical charts, is just going sideways in there. What this one is doing, like just trading in that range and letting that 50-day catch up. So you've kind of got a mixed bag there with the mega caps being strong, but not super strong. Let's go over to the Qs, which is another way of looking at the megas, but this has got everything else in it. And this one was able to go into new highs. So there's some mixed signals here, but it's good that the small caps are starting to, participate again. MDY, which I don't have, that one is also, looking interesting. So we might do something with these in the near future. And while we don't need the small or the mid caps to participate, and frankly, we don't need anything but the FNGS type stocks to participate, we prefer to have more merchandise to pick from, and that's why we've got 20 positions, all 5%, and there was like 10 more things that we could have put on today. And so we like to be cognizant too of people trying to follow the product and not having too many alerts, if at all possible, in any given day. But that's the good thing, so you
Mhm.
look at the market in all sorts of
And of course,
ways.
the downside sometimes to having that many positions is if you do get a market hit, then it's like, you know, a
Yeah,
lot of, and it almost seems like panic, panic selling, but it's really, again, just getting the exposure right, because that's something
exactly.
that is so important to you.
Yeah. So, if this is your first time watching a swing trader update, the most important part of swing trader in our minds is the exposure amount, and that's the message that we try to pass on through people who take the swing trader product on a daily basis. Is how deep in the market are we? And we're going to talk about that in a little bit about how we navigated, July and early August. And this is, the big part of what we do. And then everything else falls into place after that. Then the next thing is what sectors, and we'll talk about that as well, and how we like to spread out or concentrate different times. We'll do different things there. And those are the first things that we look at. And then it's the small aspects of where exactly do we buy it and where exactly do we sell it. And as you were talking about the panic selling, what tends to happen is we will update our stops, our internal stops,
Hmm.
on all of our stocks. And we don't release those out to everyone. And there's a reason for that. If we released them out, you'd have people playing against us and trying to bring the stock in to just, you know, hit that stop and then have it just bounce up. So we have our internal stops. And lots of times when the market's coming in, it just triggers all of them at the same time. And I've just learned a long time ago that when your stock hits a stop, just cut it. Don't sit and vacillate and wait. Now, if you've done too much in a short period of time, sometimes you have to take a pause so you don't get too light too quickly. You'll do that, but most of the time, if a stock hits a stop, out it goes. And
I
then,
would say the one exception is sometimes at the beginning of
yes,
the trading session, we might give it 5 to 15 minutes just to see, okay, is this, are the first bars ugly and then it gets uglier, or is it some type of rebound? And then a lot of times it means, we're moving up all of our alerts to the low of the day,
yep.
or trying to adjust in that way. And sometimes we still get rid of them, even if they don't come down and take out those lows, but it does give us a little bit of that. Okay, let's let the market think about stuff a little bit before we have any knee-jerk reactions
That's
too
such a
far
good
one way.
point. Yeah, that's such a good point, Justin. So yeah, when you're having, whether you're following our product or you're just doing it on your own, if you're swing trading, and yes, you have a lot of stops that are being triggered with a gap down, you want to look at ahead of time. You want to have a rating on each stock. Like, this is my A stock, this is my B stock, and my C stock, and so on. So when they're all hitting at the same time, you're getting rid of your C stock first, trying
Hmm.
to hold on to your A stock. And like you said, at that point, what we'll do is, after about 15 minutes of trying to live through the mess of a gap down open, which they happen all the time, we put our alerts at the low of the day, because typically your weakest stocks will then take out the low and then keep going lower. Um, but
Right.
yeah, so much. I mean, we could be talking for 5 hours, so I know we want to go
Well,
through.
I'm gonna go to a couple questions here real
Sure.
quick.
Yeah,
Number one
go ahead.
is, can you sit closer to the microphone? I promise we did a mic check. He wanted to call it a Justin check, but we did a mic check, but a number of people are saying that you are coming in a little bit low. So anything you could do to adjust that would be awesome. I also
Okay.
wanted to, because someone was asking, and I think it's great that we lost your video, but okay, you're coming in and out. So someone was asking, and this is great because we can look at the YouTube comments and kind of get some feedback from folks. Someone was asking, a lot of times you say on the alerts, to make room, and the person was asking, okay, does that mean that you would hold it otherwise, but you are trying to make room for new buys? And this is kind of a mixture, right? We're looking so closely at our exposure, and we want to make sure we're not going too far one way or the other. But what that means sometimes is kind of those C stocks that you're talking about, the stocks that maybe haven't moved yet, or there's something that's looking a little funny, or maybe it just didn't do what we expected. Those are the first ones to go in order to make room for some of the other ideas that look maybe a little bit better. So again, a lot of times they're not necessarily doing anything wrong. It's just maybe they're not doing as much right as we expected them to, or there's better merchandise. Did you want to add anything to that, Mike?
No, I was having some
Oh, now you're
technical
coming in
problems.
loud.
Okay. I was
Yeah.
I was Is that better?
Yeah. Well, we'll adjust. We'll see.
Okay.
Yeah.
Sorry, man. Like, I had to re-log on, so I missed a little bit of that. But
Uh,
if the question was about well, I think you
Making room.
handled it.
Yeah. Yeah. So,
Yeah, you
okay,
can go forward.
let's kind of walk through a little bit, because as you and I were preparing for this, there's some, Mike, of course, is never one to like flex his muscles and say, "Oh man, look at this." But there were some areas
If I
here.
went to the gym a little more often, I would.
Maybe you would. So because last time we met on this show was a month ago. Let's just kind of start maybe back here at the end of June. So we were coming into the 21-day moving average line. We had a nice bounce off of that. We were we were pushing this pretty hard, because we had come down to maybe 70% invested down in here. Started really pushing it hard, got on margin. We were all the
That
way.
upside reversal test of the
Yes.
21-day was really the key there, because every time we look at the market, you think, okay, what would be normal, to happen? And when we came down to that 21-day, we've been above the 21-day for a long time at that point. A pause and a closing down underneath it and then going sideways for a few weeks would have been normal and natural. And when that didn't happen, and it had every reason to, after we'd moved up off the bottom so quickly, and it didn't want to do that. It told you a few things. People were underinvested, people were short, and when you gapped up, you were going to just keep going, and that's exactly what happened. So when we saw that upside reversal, from memory, we gunned it, and then kind of kept the gas on there for a bit. And then, sorry to jump in. Go ahead.
No, absolutely. So yeah, we were about 70% in here. Really gunned it back to full. Someone was asking on YouTube, hey, how are you fully invested if you have half positions? Well, as Mike said, we have 20 positions, and half positions are roughly 5%. So 5% times 20, there's your 100%. We're a little bit over 101%, but that's what we did. We were back to fully invested in here, kind of pushing it. Now we did on this day, this was the end of June, and July started with a little bit of a hit. So we were 125% invested on at the end of June. Came down a little bit, came off margin, down to 86% here, but then really started pushing it again. Now, we had some times where we came off margin and everything, but we were always like, I think it looks like the lowest we got was maybe 97, 98% invested as I'm looking at stuff. But then as we got up to this area, we recognized that we were getting a little extended. It was a little bit harder to find stocks that we were that had good setups. We did have this day on 7/16 where we went back on margin because we had another kind of reversal. We had this downside reversal where we lightened up a little bit, but then started pushing it again back on margin. And then in here, we start coming off margin. So these are closing values in terms of where the model portfolio was. But on 9/28, which is this day right here, we were at roughly 92%, 92.5% invested. This downside reversal on 7/29, we went to 72% invested. We stayed light here. We just didn't see that much to do. So we were down to 57% invested on this day. And then this big downside reversal that happened on July 31st, we were down to 31% invested. And of course, that was very helpful when the NASDAQ took a really big hit. And I mean, we were down, Mike, you and I were kind of scratching our heads. It's like, I mean, first of all, thank goodness that we had the foresight to, really act on this downside reversal, recognizing that we were extended, recognizing that a lot of things were looking like they could come in with more weakness. We didn't know how bad it could get. I don't think I was expecting it to be this bad, but we certainly expected more weakness. And so 31% invested. We were actually kind of complaining maybe that was a little bit too light until it gapped down the next day on the jobs report. And so, I mean, we were down 0.85%, and that was going into the day 30% invested. So it was like, wow, we really would have probably gotten clobbered had we not been lightening up into this area here. And I think, to your point, Mike, you brought up that you were looking at the precedent. It was like, oh, things could really get choppy here. It might go to highs, but the character change might make things tough. And so we didn't really get back on margin until just the last couple days. And again, it's not even really margin. It's like, 101. But back to 90% invested right after this filling in of the gap, and we've pretty much stayed fully invested since then, or at least full exposure. So anything to add on that, Mike?
Yeah, so I would say, what folks should do with the SwingTrader product is really, try to think through, we don't have the time to write out all of our thought process on, why we're removing this because, and, in great detail, and we can't, we just don't have the time to be able to say, okay, on a downside reversal, this is what we're looking at. I wish we had the time, but both of us are stretched thin as it is. But really look at what we're doing, because it is not random. The fact that we got so light, we were taking on a ton of risk being that light in the middle of a power trend when on that, I think you said like 30, 31% on that downside reversal before the gap. I was contemplating in my own account, I was doing some SQQs and things, the inverse, to protect some positions. And we almost did that with the model portfolio, but we try to save the SQQ and things like that for not something that we would take off in 1 or 2 days, going into it that way. And I really thought we were going to be down 3 days. I thought we were going to be on a trip down to the 50-day. That would have been normal, even maybe a little bit underneath the 50-day. And that would have been normal and natural. And so that was my base case on that top day. And then when we crashed through that 21-day, I said, okay, well, here we are. Like, that's it's doing what it should do. But then I don't remember, it must have been some news or something. It all blurs together after a while. But that gap up with your low above the 21-day, when that happened, we just had to shift gears. But we were trying to do it kind of slower just to be on the safe side, because we have such big gain versus the S&P for the year that we can trade differently. We can be a little bit more patient. Whereas if we were underperforming, it would be different. You got to play the chips that you have. So we were able to be a little bit more patient there before pushing it really hard. But why don't you walk through the performance if maybe no one has seen this, someone's seen this chart for the first time.
Yeah. So here's kind of our look at a performance chart. This is year to date, because I think it is, we were doing a 50-day look back, but I think it really is kind of important to put that context of, just as you said, Mike, we've got chips right now. We've got chips to use, and we have been using them when appropriate. So, for example,
and the SMH on occasion.
And what?
It was a joke.
No, I missed what you said.
I said and the SMH on occasion.
Oh yes, exactly.
Those chips.
We haven't gone triple leveraged chips, but yeah.
No.
So, but yeah, as we got into a lot of the tariff, volatility in March and April, we had really sidestepped a lot of that. And while the indexes were coming down very sharply, I mean, we've just been very frank and said it was a crash. The markets crashed for a bit, but they rebounded in a very V-shaped way, very similar to COVID and a few other times, which we've gone over in past SwingTrader status updates. So watch those videos. You can kind of see what we were saying in real time, but we really didn't come off our highs very much. We stayed positive for the year, which was a big win. And then, of course, we didn't get it back in at the bottom. This is our percent invested. So you can see we did not get in at the bottom. There was just too much volatility. It wasn't really until that follow-through day on April 22nd that we really started pushing back in a big way. And you could see, even though we were maybe underperforming the S&P 500 for part of this, we had such a cushion that we didn't have to necessarily push it to the limit and be in line with the S&P 500 because we had so much room. We came in a little bit harder, I would say, probably in May and the beginning of June. I think June was our only month so far this year where we underperformed slightly for the month, but then quickly recovered.
And frankly, I've studied that, and I don't think we really made any mistakes there. It was just a difficult time for this strategy, and not every strategy is going to work in every time frame. And that was frustrating, but it was chop for tight swing trading, meaning tight stops in swing trading, like position trading where you have it wider, like a 7 or 8% stop. That's going to do better in environments like that.
Right. And it's also worth mentioning that there was a little bit of a shift. I mean, RSP, especially at the end of June, was starting to look really strong, and it seemed like there was a little bit of a shift. So yeah, it was a little tricky, but I should also mention a few of these extra lines that we have here. Of course, the purple line is our SwingTrader performance. The yellow line is our 10-day equity curve. average. So we averaged the 10-day, and of course that's at a closing range. And then the blue line is our 21-day, and here's the S&P 500. So we're very aware when we're under, when we're not necessarily doing great. And so in June we were below both the 10-day and the 21-day on our equity curve, but turned it around, and we've been trending nicely above that. Did take a little bit of a hit on August 1st, but not nearly as bad as the indexes that were below their 21-day moving average lines, and we snapped back and to new highs for the year pretty quickly. And you can see here's the 100% level where we have gotten on margin, maybe 27% on margin at most, and we've been very strategic, again, not going on margin and staying on margin, but just getting a little extra boost when we need it. So anything that you want to add there?
Yeah, I think people could use this with their own trading, whether they swing trade or position trade, using the equity curve and then the moving averages that you built this for me. I'm so grateful for it because this helps. This is where everything starts. It starts with your equity curve and how you're doing. If you're swing trading like we're doing, a 10-day and a 21-day makes sense. A 50-day moving average would make sense as well on there, but we just didn't want to have this too cluttered. Now, if you are position trading, then I would remove the 10-day because it's going to cause you to make some poor decisions. But I would put a 21, a 50, and a 200-day. And this should be where you start. Start here with how you're doing. The next thing, look at the market and how that's doing. Then we're going to talk in a little bit about how you're doing versus the market with your relative strength. But this is the most important, thing is, are you above the moving averages that are important to you? If so, you have short-term chips to spend, meaning, and that's why, we're 100, even though part of me is cautious, we're 100% invested because we're above our 10-day, we're above our 21-day, and our 10 is above our 21-day. So they're trending in the right way. If I was feeling this way and that purple line was underneath the yellow and the blue, meaning we're underneath our 10 and our 21-day, like we were there in that June timeframe, we would be easing off on how deep in the market we're invested, or which types of instruments are we picking, really slow and pokey ones or something a little bit more high octane. And so I think everyone could really benefit from doing this and it basically basing like 80% of your decisions off of this. How are you doing? You're doing well, then you earn the right to push it. You're not doing well, then you haven't earned that right yet, and you eventually will.
Let's just real quickly, because I think, again, what was happening at the end of July here, we were above our 10-day on our equity curve. We were above our 21-day. And again, we walked through it that we were decreasing our exposure purposefully. And that had more to do with levels of extension, the way the indexes were closing with those downside reversals. Again, you don't really see that on a line chart, right? You just see where it closed. But when you see, oh, this is where you were and this is where you closed, we are using whatever information we can to bring the context to it to make better decisions. So are there levels of extension that you look at to say, oh, you know what, we need to maybe get a little bit more cautious?
Yes and no. So because the no part, because look at that move up that we had in in April after the follow through day where we were really extended versus our 10-day and our 21-day. If we would have adjusted because of the extension, then we wouldn't have kept on moving, right?
Right.
But what it does is when you're extended up there, you can take risk. And the risk was, I was more nervous about being 31% invested on that downside reversal than when we were 120% invested. Because if you're 30% invested and the market takes off, man, you're dead, like from a swing trading standpoint, because now you got to play catch up, and then you're buying things out of position. You can really get chopped up because then you're buying things stretched. Then they take out your stops just to move higher. And I've been there, done that. It's frustrating. It's not fun. So that was it's very risky, but I think The only thing that was better this year that the swing trader portfolio did was sidestepping the crash. Like I've always looked at when Bill sidestepped the crash in 1987. I always wanted
Mhm.
to be part of doing that, and that's something that we were able to do with this, and that was a big deal. It's just this is one of two, a sample size of two that have snapped back like this. We had the COVID snapback and this snapback. But most of the time, they keep going down, and we were positioned.
Or like what we were talking about before was the 98,
Yeah,
where there's an undercut. Things get a little bit uglier before they
yeah,
get better, but sometimes a lot uglier. And that's very normal. And we
yeah.
had to have that in the back of our mind that, look, things could get worse here before they get better. So
Yeah, and before we move on, I think what's going to happen, and what I'm scared of, is a lot of people, ourselves included, myself included, are going to be having kind of a recency bias the next time we go into a market that looks like that looks bad, and we're going to be like, oh, well, COVID bounced back right away,
mhm,
the tariff thing bounced back right away, and I think you have to look at the wider data set and go all the way back to 1900 or further and just say, okay, what's normal and natural? What happened
yeah,
these times was not normal and natural. And that's why we just used our instruments. What were our instruments? The follow through day system that Bill came up with, before both of us were born, and then the 21 day, and then the power trend that you and I developed with Charles Harris. And we leaned heavily on that. So just trust your instruments. You don't have to use those. You can use whatever else you want, but just trust your instruments, and that's what we did, and I'm very happy with it.
yeah. And someone was saying, hey, you guys had the good sense to stay on the sidelines during Liberation Day and all of that. And let's be honest. Again, this is apolitical decisions right here. I personally have no idea if the tariffs are going to work, if they're not going to work. I don't know that now. I didn't know that in March, and I didn't know that in April. Just like in COVID times, I didn't know how bad things were going to get. But we're using the market, and it really kind of takes the pressure off of all of that macroeconomic, like, oh, I need to know exactly what's going to happen in the future, the forecasting element of it. We're just looking at, this is where we're at right now, this is how the market is reacting to the news, and so we just try and stay on the right side of things. And again, it really doesn't matter what your politics are. In fact, if you try and make I think a political decision, sometimes that can come bite you in a big way.
Big time, big time.
Even
They're like,
even headline wise, yeah.
keep your
Um,
politics to after the close.
mhm,
Before the close and after the close, totally fine if you want to be hyper political. I have been over the years at times, but not when it comes to the market. Whatever the market sees through, and it was able,
yeah,
it's clear, right? It's clear as day what has happened, and the market was able to digest what ended up happening. But at the time, the market wasn't sure, and that's why it fell apart, because it didn't, it needed time to process all of that new information. Just like the deep seek was a big
mhm,
deal, the Fed, the first Fed thing, I think it was December
December
18th.
18th. Yeah.
Yeah, there
Mhm,
was an issue. Like, so the market can take hits, and then when it digests it, sometimes like 1973, 74, it digests it and has to go a lot lower, or like
mhm,
2002. So it doesn't always digest it and think it's positive. The market has looked at this so far and said, okay, well, it's positive. And now we're continuing in where interest rates are going to have to come down from the Fed, right? He's not, it has nothing to do with what President Trump is doing. It has to do with what the data is doing between
right.
unemployment and inflation data. And more importantly, the fact that he had two people vote against him. So he can't risk. So almost the risk of the Fed is pretty much off the table in my mind right now, because Powell cannot risk having three people or more dissent against him. And so he has to kind of go with what things are. And I thought that early on, when the Fed funds futures were saying something completely differently, I was like, oh, this is my personal opinion. I guess I'm wrong. And then it took one more day, and then the Fed funds futures completely flipped. So
Yeah.
it is what it is. But
But
yeah,
even that, I'll just, I mean, that's getting even more into the weeds than
Yeah.
we need to, right? Because at the end of the day, what our decisions are really based upon is what's happening in the market. You know,
Yes.
yeah. So a
100%.
few things I also want to show here in terms of our charts. And yes, someone was asking about the black line. I thought that I mentioned that the black line was the S&P 500. That is absolutely the case. These black lines down here are just putting where the 100% and 50% invested is, so you can kind of get that sense. But we also should mention that this was again a very deliberate thing. In our last meeting, we talked about the portfolio ATR. I think you also came on the podcast not too long ago where we went into some pretty big detail on portfolio ATR, making that calculation of saying, okay, here's my position size, here's what the 21-day ATR is for the for the stock or the equity, and then you kind of do a sum product and say, okay, here's what my portfolio ATR is. Of course, cash has an ATR of 0, right? It doesn't do anything; it's just flat. But it gives you a sense of when you're really pushing it. Which, as you said, end of April, we were pushing it, and again, we had the chips to do that with. But more recently, we've been kind of more in the 3% area. And considering that a lot of times we were on margin, up to 27% on margin, 3% is actually not very risky. And the way we were doing that for a while there was we were putting on more ETFs, things with some lower ATRs, Goldman Sachs, for instance, and granted the ETFs, like even SPY and QQQ non-leveraged, those ATRs were pretty high in here. I
I
mean,
think they were in
those
the
were,
threes, right?
yeah, over
Yeah.
3% for SPY and the Qs, over 3% for both of them. And then in this area, they were down below 1. So that's where we were using TQQQ, SPY, UPRO instead of SPY. But talk a little bit about the ATR now, and we should also mention some individual stocks that might be skewing that currently.
Yeah. So, and we'll talk about that in a second. That what you see here is our ATR, and if you're new to ATR, average true range is how much a stock or an ETF fluctuates in any given day, including gaps, and it gives you a sense of volatility, historical volatility. You never know what the future volatility is going to be. If you know, please DM me what that's going to be. But you just have to base it off of history. And so we use a 21-day ATR, and then this is, as Justin said, is the summing up all of our holdings and where it's at. And some of them are inflated. We'll get into that a little bit. But so we have more room to push this higher once we get up above 4. If we do that, it's very deliberate. And it's like, okay, we're pushing on the gas right now because, but right now we're not at 4 because I'm a little bit concerned. And we have the chips that, you saw the performance, we're doing great. So we don't have to push it. If we were playing catch up, it'd be a little bit of a different situation. So now what we do is we risk the S&P coming up and catching us. That's a different place. That's a better place to be in. You're not always there. So take advantage of it when you're there. So with this, we had brought that all the way down in there. And as you said, even on that gap down day, we still were down a lot more than we wanted to be, with only being 31% invested. So
Right.
yeah, do this on your account. Like if you've got a bunch of heat in your account and you go and do this, again, just go into Market Surge. It'll tell you your 21-day ATR percent. Put that in there along with what percent of your account it is. And if you're on margin, you got to add that up as well, And so if you trade on margin, you can have some really wild ATR portfolio ATRs. So you don't want to kid yourself. Just because you're spread out doesn't solve it. It's spreading out as well as different sectors will help reduce risk. Putting some ETFs in there will help reducing risk. So there's ways of doing that, but your lower ATR is probably your best way of reducing your risk if you still want to be deep in the market.
Mm-hmm. Absolutely. So let's talk about some of these stocks that maybe are skewing things a little bit,
Sure.
because look, every indicator has those times where things can get a little out of whack with it, and again, there's no such thing as perfection in that regard. Everything has its flaws, and what we try and do is just be very aware of how something might be flawed. No, kind of, we always say we know where the skeletons are buried, and everything, so that we know how to use something properly. But I'm going to go ahead and switch over, because one of the stocks that I think really demonstrates this is Fix, that we just put on today. I do have a position in this
I
myself.
have a position in it, and you said another. I think you said Goldman Sachs, and I do have a position in that.
Oh, okay, yeah. You know what? I did have a position in it, and I think it was like just not doing anything, and I didn't add it back today, when we did. But here's an example. I mean, we look at this, and you say, "Well, gosh, this is such, such tight action, and it's awesome." And then you look at the ATR, and you're like, "Wow," because let me just look real quick. I think
think
the
it's a
average,
4.2.
yeah, our average is under 3.5, and for Fix, it's like 4.2 exactly. And you're like, wow, that it seems like that wouldn't be moving that much. But you got to remember, you've got this day right here where it gapped up on earnings, and that was 22%. So the average true range is going to be skewed. It's only 21 days. So it's going to be skewed by that one day. And Fix is not the only one there. Again, we put this on. I want you to talk about this, Mike, because I think it was really good. It was put on when it was down here, kind of as a setup, right? It hadn't even crossed above this high, so it was very, very early in terms of getting in on this. But you liked the setup, and then it just ended up kind of throughout the day. It just kept on pounding higher and higher.
Yeah. So this is still looking really good. I think it's still, I think I said I have a position in it, but
As do I.
now before, when we were still underneath the highs of 2 days ago, and where we put it on, and it was quite a bit under, or it was underneath there, and it looked like this should happen if the market was going to continue higher. So lots of times what you do is you look at a chart and you say, okay, this one is set up to move higher. Where is my risk where I know I'm wrong? And is it worth jumping in a little bit early before you get your true signal, or should you just wait? And there's times for each one of these. And with this one, it was like, okay, we're going with a half size position with everything. So that reduces your risk. So instead of a 10% position, we're doing 5% position. So that allows us to do something like this. And then we knew that, you know what, we knew when we were going to be wrong. If you really underneath yesterday's low, if this would have closed down into the 690 or underneath that, it was going to be on the bubble to just exit tomorrow. Was that a possibility? Absolutely. Every time you trade something, you have to assume it's going to hit your stop, and really assume it's going to hit your stop, bounce up, and go up just to frustrate you, because that's what they like to do. But this was set up so nicely that you were kind of anticipating what ended up happening, and it's just kind of textbook picture perfect. It also gives you feedback on the market when you see stocks doing what they should do. So let's say we never traded this and we were just watching it, and you were looking at it intraday and going, I don't have any more capital to buy. And we were both talking about how we were personally tapped out. We had no more buying power in our own accounts. And then you see something like this, like, let me just watch it, and that will give me feedback on, is the market healthy, and is this sector healthy? And I will say, building in general, looks very interesting. And we tried XHB a couple of days ago. Let's just go there for a second. I was very frustrated. I missed this one. I did end up buying it in my own account late in the day, but I was stuck in some meetings. We had tried this a few days ago, and then just had to back out of it because it wasn't working. But I think this is good for the overall market if we just rotate out of, just get away from this AI only type of thing, and having home builders participating. Another sign that the market thinks that the interest rates are going to, keep moving lower. Of course, this is based off of not short-term interest rates, but mortgages. And so it's a little bit apples and oranges. But I think this is good for not just home builders, but anything building related. Now you've got some building stuff that is more for the AI stuff, and we play those, and some that are more for just normal construction, whether it's residential or retail. But anyways, this looks really good. We're not in this. Frankly, if I would have seen this a little earlier in the day, we probably would have put it on. But by the time I saw it, it was just stretched a little bit too far, and we were already in fully invested. It would have meant we would have gone on margin, which I didn't want to do today, or sell something, and there wasn't really anything in position to be sold. So sometimes you pass up on things because you don't have any money left. And so I think everyone should keep that in mind as well, because sometimes I'll just sell things just to buy something new when there really wasn't anything wrong with it. Sometimes that works out, but a lot of times, you just kind of spin your wheels.
Yeah. And yeah, it's certainly one of those things that is challenging sometimes, right? You have to remember that, okay, you're balancing that. Oh, I want things to have an impact on my portfolio, but I have to have it at a manageable level. And there's only so much cash you have, right? Or margin ability. I only use cash accounts. Someone was asking how many do we have in our personal accounts? For me, I probably have 25 positions, and that's spread over five or six accounts. So a lot of them have the same position, right? I've got them in multiple accounts. There's some where it's like, oh, you know what? I have a little bit of buying power. I'm going to put this in. That was the case with Fix. I have like a tiny position in Fix because I just didn't have buying power, and especially with only cash accounts, it's very easy to run out of that.
Yeah, and I'll have my number of positions is pretty much can be off the reservation with what most people do. At times I'll feel comfortable with 40 or 50 positions.
I can't do it. I can't do
And
it.
but then
25 is pushing it for me. Yeah.
Yeah, but then I'll whittle
Yeah.
them down.
Yeah.
And there will be times where I only have 3 or 4 positions and I'm on margin. Like Bill O'Neill, the founder of IBD, would always say 5 to 8 positions, but many times he'd whittle it down to just 1 or 2 stocks. So you got to find what works for you. And with like with this product right now, we've got the 20 positions, and we're trying not to, but we might have to take some of these half positions and bring them down to quarter positions, because if his stock isn't doing anything wrong, but we need a little bit more cash, we might have to trim a little bit into strength. And we're trying to avoid that, not because I think there's anything wrong with it at all. I think that's the better way to do it. But we also know that everyone can't follow that many stocks. So it's a balancing act. What we end up putting out isn't exactly what I want. We've got to balance it to allow people to be able to follow it.
Know your audience, right?
Yeah.
So, you know what? Let's also just kind of run through real quickly, because man, I can't believe how much time
Oh
has
shoot!
passed
Sorry.
already.
Yeah, it was a good episode, though.
Yeah.
Hey, everyone got what they paid for.
Right, exactly. MedPace, 6.4% ATR on this one. And again, a lot of that has to do with the fact that this went up so sharply, up 54% on that gap up on earnings. But look at how tight that's held lately. So that's what we're keying off of. But it is skewed because of that 54% gain in a single day. So again, 21 days, and one of them is huge in that regard. Also CLS, which has an ATR of 5.78. A big day here. And again, fairly tight action, but we put this on a few days ago. Oh, you know what? I do have positions in both MedPace and CLS.
Let's just assume, because I don't have my brokerage, I was trying to do it on my phone, but let's just assume that I have positions in everything that we have. One thing on this ATR thing, you and I pre-show we're talking about doing like an adjusted ATR, which would be nice, where you exclude the outlier, but you would only exclude the positive outlier. So if the CLS had gone down as much as it has gone up, you'd want to include that in there as a risk management, but
you want that punishment in there.
Yeah, because you want to get a sense of what you're really trading, and that was an earnings announcement move. and those are always going to be big. So maybe in the future, we'll do an adjusted ATR, but we're just kind of mentally doing it right now.
Mm-hmm. Now, there were a few stocks that we were trying to hold through earnings. Toast was one of them. I just wrote about this one in the column. So you can get that at, if you go to investors.com under the research tab and SwingTrader or Swing Trading, you can go and read that column. Our intention was to hold this through earnings. We brought it down on this day to, I think we had
A
gotten it
quarter,
either.
right?
Yeah, we had brought it down to quarter because we started as a half. Like we've been doing. I can't remember if it was either this day or this day. I think it was the second one. Got a nice move the very next day. We had some cushion. We were like, yeah, we can hold this through earnings. Let's take a quarter off here. But then this day happened. We're like, oh nope, forget it. We'll
Yeah.
And look, it came back, but then we ended up sidestepping this whole thing. It didn't have the greatest of earnings reactions, and it hasn't really recovered yet. Another one that we said we're going to hold through earnings was Palantir. We went down to a quarter position a couple days ahead of this earnings report, and then on the earnings report we went and made this full. So added a 3/4 position to it. Yes, that rose our average cost up quite a bit, but we had already taken some profits. We were kind of buying that position back and then some. And now we've taken this back down to a half position, taking half the position off as we got some strength in it. Anything to add on those?
Yeah, I do. I don't own any
Oh, and I do
toast,
have Palantir,
but I do.
and I
I
do
do
not
have
have Toast.
Palantir.
Yeah.
Yeah, and so that's a way of managing risk going into earnings, which most of the time with with the swing trader product, we don't hold into earnings because, look, you can have a great. Let's pull up Microsoft for example. This was one that we were holding, and we were also thinking about holding it into
That's the
earnings.
one I was thinking of.
Yeah, I just thought of it now. We were trying to remember what it was, and
Yeah.
we decided to exit it,
Yeah.
but we also exited. And Amazon was the other one. Let's pull
Hmm.
up Amazon for a second. And I was like, look, we sidestepped both of them. We sidestepped the gap up on Microsoft, but also the gap down on Amazon. So all things being equal, it's okay. It's okay. And now you look at them and go, I don't really want Amazon in this position, but I was looking at Microsoft earlier to possibly buy or to for us to put it on to swing trader, and I think that looks good. But another way of just being exposed to the market if Microsoft drags other things up, because we've got like Meta and Google, and so we don't have to have all of the big caps on there. But this looks good, and I think Meta looks, and I do have Meta.
I do have Meta as well, and
I don't think
Alphabet.
that.
Hmm.
Yeah, I might have Google. I'm not sure. But anyways, I think the Meta looks really good and looks like a magnet for 800 and beyond. Whether that happens, we'll have to see. But if it doesn't happen, just like the fix that we were looking at, if this one were to come in and go underneath that little shelf that it built, that would be a little piece of the puzzle of telling you that the market isn't acting normal and natural. So that's another thing that everyone could do is just put alerts on all of these stocks, even if you don't own them. Go through the biggest stocks out there and the ones that have gone up the most. Put lines in the sand saying, okay, as long as it stays above here, it's acting normal and natural. And if you see a bunch of those falling below it, not just one or two, but a bunch of them, that's another sign that the market isn't as healthy as you would have hoped. But also just focus everything. Really, it starts, like we said, with your equity curve, how that's doing, and then how the indexes are doing. Everything else is really smaller of importance.
Yeah, we're going to end on this note. No, we went a little long today, but right now, as mentioned, we're 101% invested, pretty spread out. You can see that in terms of the sectors. Our I'm saying ETF here. This is ARK-K, which I do have a position in this. We have other ETFs. In here, utilities, for example, it's UTS. That's our utility exposure. But we instead of saying that's an ETF, we're saying, okay, well, that's in the utilities sector because it is a targeted ETF as opposed to a broader one. But yeah, you can see that we're pretty spread out. And that was, again, by design, as you said. Let's go ahead and get your closing thoughts here, Mike.
Yeah, I believe I have positions in both of those as well, just to be on the safe side. And hey, look, it is they were never going to make it easy. And just because the market's at fresh highs, don't think it's going to be easy. You've got to stay nimble, both on it being strong, getting stronger than we think, or weaker, and just honor your stops. And I would go back and listen to the part about the equity curve, and then the podcast that we did a while back on the whole ATR thing, because that's such an important part of building your portfolio and knowing what type of risk. If you want to take on a ton of risk, there's nothing wrong with that, as long as you're aware of it. You don't want to be caught off guard thinking that, oh, I own 30 stocks, so I'm safe. But if you got 30 stocks that all have 10 ATRs and they're all in the same sector, you're taking on a ton of risk. So just, be careful out there. And hopefully everyone tries out the product, man. I think, I'm very proud of it.
Yeah. So again, you can always go to investors.com and click on one of the SwingTrader links. I think we probably have that in the YouTube. But yeah, come join us. And thank you very much, everyone, for watching. Quite the audience here live. Really appreciate your questions and some of the side conversations as well. And yeah, it's great chatting with you all. And we will see you next month. Take care, everybody.